Hello everyone and welcome back to the Option Writer. What I wanted to do tonight is just go over a couple things using Fibonacci's mainly and also kind of recap a couple of charts that I think are really interesting over the last couple of weeks and months. I'm going to start off here actually on the US dollar index here from Deutsche Bank. I think this is a really good one to kind of show you guys how to use Fibonacci's when the market's falling and where turning points could be in a security as it's falling, and giving you a good rough estimate. A lot of people, what happens is they see a security falling and they just go, well, I don't know when to get in, I don't know where the bottom is. So using Fibonacci's is a great way to kind of look out for the next support level in the market. Now you can see that back here the dollar index actually used the Fibonacci levels here in blue to bounce off of before it made its high here, which is where the top of our Fibonacci line is drawn. Then when it started to come back down, it used that same level again, and you see it held that support level for a little bit until it broke hard. Once it broke hard out of that level, it immediately ran to the next level, held that level for a little bit, ran down to the next level, bounced off of that level, hit its head off of this level here, and now it's down here once again at another Fibonacci retracement level. So you can see every time that this security fell, and this is the dollar, mind you guys, it actually bounced off of these Fibonacci lines pretty good, or at least held support at these Fibonacci lines before the next leg down. So these are really good targets for a couple day trade here. It's a couple swings in the market. Right now you can see it's holding very nicely at another Fibonacci line, so I wouldn't be surprised at all if the dollar had a nice little pop here, back up, and then your target obviously would be the underneath of this Fibonacci line here, right around 59 for this particular index. Now if we go over to the S&P, it's actually been really good over the last couple of months using these Fibonacci lines, and you can see that it's been bouncing between these two lines here in blue for the last couple of months, mainly between May and August now. And you can see that in May and June it ran up and hit this 50% retracement level here right around 1,120, ran away from that level, and again bounced right off of the next Fibonacci line almost to the penny. It bounced off of that line, and now it's come right back up and it's hitting its head and stopping once again at this Fibonacci retracement level. So you can see all these levels are drawn on your chart and they're kind of projected out. So the next logical move down for the S&P obviously would be back down to at least this Fibonacci level here, acting as support. Now if it does get a strong break above here, which I don't see it happening considering that it's already had a nice long sustained move, then obviously the next major target would be up here around 1230. Now that's not to say it's going to get up there in one full swoop. I'd more be interested to see if the market came up halfway, came back down, and bounced off this level before continuing up to the second half. So again, you can use Fibonacci's as a great indicator, a great little lookout tool. They're not always perfect, but they do tend to be really good at giving you a general area of support resistance on a chart. Now the last thing I wanted to look at here tonight is just a kind of topic a little bit off, but it really brings home the point that we want to make about where the equity markets are right now, and I'll kind of center this photo. Here's the monthly flow of money into mutual funds, and you can see that U.S. equities are in blue and the bonds are in orange here, and you can see that over the last couple of months, and really since the beginning of 2009 and 10, there's been a lot of money flowing into bonds while money has been flowing out of equities. And you can see that most recently in May and June and July here, there's been a lot of outflow of cash from the equity or stock markets and a lot more inflow into the bonds. Really what this is telling us, everyone, is that most investors are getting a little nervous about where stocks are. They think they might be priced too high, or they may not be giving them a good enough return over the next couple of years. So instead of moving their money, putting it into stocks, or taking their money out of stocks and putting it into stable bond funds. So again, this is not a good trend for the equity markets. It doesn't mean that things are going to roll over immediately. It just means that the smart money really is kind of getting out of the way before things get crazy. As always, happy trading.